my experience has been with clients go to their accountant and they say, well, here's your tax bill for the year. And the client will usually react and get upset. It's like, well, how can I lower my tax bill? The accountant automatically is going to say, well, you have to contribute into an RSP. So if you contribute $10,000 and you're at the 50%, you're going to get $5,000 by way of a refund. You only pay $5,000 in tax. So then the client's like, wonderful. But the accountant doesn't talk to them about, yeah, but here's what happens 20 years from now, 30 years from now. Here's what happens at death.
Wake up, it's time to rise. Talking money with sharp insight. Jim and Ryan here to guide. Mastering the money ride. Saving stacks and planning dreams. Living large by honest means. Tune in now for the schemes. Breaking down financial themes. Money mindset every day.
We're going to welcome everyone again to the Money Mindset Mastery podcast from TVH Group's new head office in downtown Toronto at the Eaton Centre. And I guess it's also doubled as the Money Mindset Mastery podcast studio. Right, Ryan? At least we're trying to figure that out.
That's right. The Batman layer. And hopefully we have working stuff. Otherwise we need to hire, what's this guy's name from Batman? I can't remember his name.
I don't know. I'm losing it. Anyways, today we're going to be talking about how you can avoid paying hundreds of thousands of dollars in tax. Right?
Let's do that.
Yeah, because I think it's really important. A lot of people don't realize that they do pay a lot in taxes, especially at death. And there's a number one culprit for it. Well, maybe one and two. There's a secondary culprit to it as well. But we're going to start off with playing a bit of a video. It's a newscast from CTV that talks about the specific situation, and then we're going to get into it from there. So let me share the screen and find out about how this family lost over $660,000.
He describes her parents as hard workers who saved to buy a cottage in 1998 and always put money away in their RRSPs for their retirement. 5 years ago, they sold their home and made the cottage their principal residence. When they both died last year, Gallia's mother's RRSP rolled into her father's for a total of $715,000. When her father died, the RRSP had to be taxed as income at about 50%, and there was capital gains on the cottage. The family had a tax bill of $659,000.
It made me more angry than anything. We've just lost both of our parents inside of 11 months.
Gallia says to avoid selling the cottage, almost the entire amount of RRSPs her parents saved had to go to pay the tax bill. She says she and her brother expected some of the funds and were shocked almost nothing was left over.
What happens to the RRSP? Maybe there's a better vessel to put that in so that it does pass on to your kids or who you'd like it to pass to.
You want to do some retirement income planning for tax efficiency, at least by the age of 55 or 60.
Tax expert Evelyn Jack says families should adopt a strategy to reduce the amount of tax they pay, use life insurance, and get advice from a professional to avoid a massive tax bill when a loved one passes.
Take a tax hit earlier on so they can avoid a top marginal tax rate at death. And in the process, put that money into more tax-efficient vehicles, for example, a TFSA.
Gallia says she's still grieving the loss of her parents, but wanted to share what happened to her family to help others.
Other people learn that maybe RRSPs aren't the best option for them, then at least I've done something to be helpful or beneficial, and I think my parents would be proud of me for that.
So this situation really isn't new to us. It's things that we've warned our clients about many times over. So I don't know, what do you want to say about the situation?
It happens time and time again, and you alluded to it. You know, it's poor planning on many different parts. You know, there's a lot of institutions that often push the RRSPs. Now, we would say it's a time and a place, and the proper planning. You know, we use great tools and softwares to allow us to make sure that we can project what that red line is going to be. The secondary, as you kind of alluded to, and which is, you know, the tax accountant, of really being focused on this year and not focusing on a longer term plan. And it's the reason why we do what we do and we have the group that we have is because each of us can talk about a client's case specific to what their goals are, what the strategies that we're trying to create for them. And it's not a cookie cutter that, you know, you just want to save tax this year, that's fine, but not truly understanding what the end game or end result will be for you. For some, it's not my problem, I'm gone. It's more of passing on to the next generation. And again, it's unfortunate that, you know, our families, you know, just like ourselves, for kids at any generation, what will be coming down the pipeline as far as our family's legacy, because they've worked hard for it. And, you know, in this case, the family not only had RSPs, but they also had a capital gain on the cottage itself too, which, you know, when you're faced with not only the passing of family members, there's a lot of emotion going on. Do you want to deal with everything else that is, and to then be slapped with a $659,000 tax bill really hurts. And I don't. I think had the family gone back and sat down with an independent advisor and really understood what the outcome would be, I think more planning would have taken place, more dialogue would have happened. Whether it's today or a previous recording that we may have had 15 minutes ago, you know, our ability to have those dialogues with the family as a whole as to what you want the outcome to be can be really beneficial. So
Yeah, you know, going back to hard workers like this family, they did the right things. They worked really hard. They saved as much as they possibly could to experience a comfortable retirement. They bought a cottage back in 1998, hoping to share it with family and the next generation, without really anticipating what would happen in the event of either one of them passing away. Right. So, unfortunately, in this situation, bit of a double whammy because both parents passed away within the same calendar year. So, from a tax point of view, that's definitely made it a lot worse. But even if it was within a year or two, it still would have been an issue, right? Because the bottom line is when we talk to clients and we ask them, do you know what happens with your RSP when you pass away? Many don't really have the right answer to that question.
yeah,
Either they will say it's going to be passed on to my kids without tax, which is not correct, right? Usually that's what the expectation is. Some do know, yeah, there's some tax, but then when we actually explain to them how much tax, they're usually surprised,
yeah,
right? So when you take the registered asset, the RSP, plus the cottage, which was a secondary property, the way CRA treats the taxes and those accounts at death is that they actually do what's called a deemed disposition. So in the case of the RSP on the second death, they will basically state that or treat it as if the individual who passed away cashed out their entire RSP account the day before they passed away. And then that gets added on to income for the year. It's the same thing with the secondary property. So keep in mind, this isn't on primary residence. We don't pay capital gains on primary. This only applies to rental properties, recreational properties, cottages. But they kind of treat it the same way as if you sold that cottage, in this case, the day before passing away. And that triggered a whole bunch of taxes. And we will say that it's not that the kids did not walk away with anything. They were able to preserve the cottage as part of their family and the legacy. But in order to pay the entire tax bill, they had to take the money from the registered accounts, $660,000, to pay the entire tax bill created by the RSP and the cottage, right? And then there's a bit of a double whammy because now whatever the cottage was valued at the day of the second death that triggered the capital gains, well, now that the beneficiaries received that cottage, that's considered the new cost of the cottage moving forward. So if their intentions are to leave it to their children, there's going to be another capital gain issue down the road, right?
yeah. It's a repeat.
Yeah.
And
And go ahead.
no, I was just gonna say, like, you know, there's a lot of proactive steps that families can take to protect their hard-earned savings, to make sure that this unexpected tax consequence doesn't happen. Working with ourselves in a group allows us to look at each client's situation and how they want the outcome to be. And, the challenge for a lot of people, not only going forward, is really, are they confident that their current plan and estate will come out the way they want it to come out versus passing it down to the next generation, right? So,
yeah. Well, let's talk about passing the next generation, because in terms of who's at fault with some of these errors, I don't know if it's fault. I think it's bad advice. Because if you speak to the banker, they will encourage you to continuing on contributing to the RSPs. And I used to be a banker. We used to have our RSP season, right? We used to put in extra hours and encourage everyone to contribute to an RSP. So the bankers are kind of at fault. The accountants are also at fault, right? We've talked about this, and sorry, Dave, our tax accountant, our partner here at TVH Group, but the reason why we work with him is because he thinks differently than your typical accountant. But my experience has been with clients go to their accountant and they say, well, here's your tax bill for the year. And the client will usually react and get upset. It's like, well, how can I lower my tax bill? The accountant automatically is going to say, well, you have to contribute into an RSP. So if you contribute $10,000 and you're at the 50%, you're going to get $5,000 by way of a refund. You only pay $5,000 in tax. So then the client's like, wonderful. But the accountant doesn't talk to them about, yeah, but here's what happens 20 years from now, 30 years from now. Here's what happens at death, right? You're just compounding and deferring the problem. You're kicking it down the road, right? So if there's anybody at fault here, I think it's, no one's really looking at the future when it comes to the RSP contribution or even the cottage strategy, right? They're just worried about today. And that's a big problem. When we're talking about leaving things to the next generation, here's what we typically see with clients who come to us. They have a cottage, and there's going to be a huge tax bill at death. Even though they may have pension plans, they've been encouraged to max out their RSPs. So now there's going to be a huge tax hit with the RSP. And then because they do have the pension plan on the second death, that pension, basically the accumulated value of it, gets reabsorbed into the pension. It doesn't go to the next generation.
I think that's a very important point that a lot of people don't realize, is that their pension gets absorbed back into the pension, because a lot assume that it's going to pass on to their next generation.
Yeah.
And it doesn't. A portion may pass on to your spouse for potentially, depending on the pension setup, for a number of years, 10 years, lifetime. There's a bunch of different scenarios, but every individual is different.
Right.
But I think it's worth repeating that very important point, that the pension does not pass on to as a legacy to your next generation. So RSPs do, but they're taxed at a very significant rate. And I think something else came up in my head while you were saying that, as far as cottage, because I think when people plan, they think, well, I've put it in my will, right? And therefore it's in the will and it will pass on to the next generation.
After tax.
Exactly, right? And that's a part, and again, that's why we bring in TVH Legal and Sonia and her team, to make sure that some of the things are matching up as to how. And that's why she often asks, especially working with us, is like, how will the family pass this on to the next, which will often lead to different strategies that we may suggest. So,
yeah. Well, let's talk about some strategies that we help our clients with. When it comes to the RSP, if you've already built that RSP portfolio, there's really not much we could do in terms of avoiding the tax, with the exception of there's strategies like RSP meltdown strategies. Not for everybody. I know on social media, I keep seeing advisors kind of speaking about like, this is for everybody and it's a great strategy. No, it's not, but it is an option that's available, right? So there's an RSP strategy to melt down the RSP. What else is there? Life insurance, right? So people will say things like, life insurance is too expensive. Well, if you had a $660,000 policy in this situation, right, that policy would be paid out tax-free, that $660,000. That could have been used to then pay the tax bill. So even if you paid $300,000 in premiums for that $660,000 life insurance policy, it only costs you $300,000 to get the 660, right? We always say, let's pass on the cost to the insurance company, as opposed to having to come up with $660,000. When it comes to pensions, one thing that people like about pension plans is that they're the guaranteed level of income, right? The problem with the pension plans, you're also guaranteeing that on second death, there's nothing paid out. There's no legacy planning. It's not going to the children or grandchildren. That's another guarantee that's going to happen. So there are options where we can take what's called the commuted value, move it out of the pension plan, and put it into a guaranteed contract that will guarantee your income just like the pension plan does, with the added benefit of transitioning that to the next generation. There will be taxes, but something is better than nothing, right? So those are some of the strategies that we can incorporate and we discuss with our clients. And it's amazing how many people, when we kind of present some of these solutions, they're like, I've never heard of this, right? And why?
And part of the reason is because strategies that are often used aren't being offered, or those institutions either can't offer them, or they just don't have the knowledge or know how to suggest them. And you've made this point very much as being a former banker too. It's like often, and there's a lot of amazing people that I know too that are still bankers, that they know in their gut there's other options, but they're kind of pigeonholed to or handcuffed to one idea and one idea only.
Yeah.
And again, the importance of working with an independent advisor is the ability to move around and use different institutions in a way that helps you as the person achieve your ultimate goal. We talk about insurance very often, and I think one of those things that people seem to forget is insurance is nice when you're younger and it's cheaper and it's something you can kind of project out. We often talk about level insurance to make sure that you can not have surprises along the way, but also plan potentially those surprises along the way. Planned surprises are always better than an unplanned surprise.
Yeah.
This is a situation that obviously is an unplanned surprise for the family. That had they sat down with an independent advisor, I know this is one of the things we do often, and I just mentioned it, is be like, here's the end red line that happens once everything's closed.
Yeah.
You're no longer here. Do you want that number to be in the red, zero balance? Do you want it to be in the green to pass on a different legacy? So it can be a very different conversation with us versus most other institution advisors. So
yeah, it's amazing how many times we show a client that red number and they'll ask, well, what is that number? What does it represent? And it's like, that's the amount that CRA is going to get from you.
Yeah.
Right? Like, well, what do you mean $500,000? And it's like, well, you've built X amount in secondary assets and all these registered savings accounts, right? That's what CRA is going to get when you pass away. And do you want them to get less of that?
Yeah.
And we do it in a legal, we don't do anything that's questionable in terms of strategies or whatever else. It's everything that's been approved by CRA. But a lot of these strategies are unknown by the regular individual who's used to just dealing with the bank, right? Last week I was introduced to a new potential client, and we sat down, and she has some significant assets. It's all at the bank. And I remember sitting down with her and asking about some of the non-registered assets that she had in GICs at the bank. And I'd asked if her priority was to spend that money or if she wanted to pass on to her 2 children and grandchildren. She said she doesn't need the money. She wants to pass it on. And then we talked about some of the estate issues with that non-registered GIC at the bank. So then I talked to her about segregated funds. And I'd mentioned to her, I said, listen, you can buy a GIC. It's usually referred to as a GIA, right, through a life insurance company. It's the exact same as a GIC, non-registered, but you can name beneficiaries on it. And because it's underwritten through the Insurance Act, or falls under the Insurance Act, not the Bank Act, that full amount would bypass the estate. And she thought like that was like the best thing ever. And I'd asked her, I was like, is this the first you hearing of this? She said, absolutely. I've been dealing with the banks, and she's dealt with multiple, and not one individual had suggested that she considered something like that, right? And then she's a bit of a risk taker. So right now she's saying she doesn't like the GICs and the rates. So that I talked about segregated fund portfolios. And once again, she's like, I would love that because I can take some risk knowing full well that if things don't work out when I pass away, that my kids are going to get 100% of what, at minimum, of what I invested, right? So all we're trying to share, and this is the first time we've talked about this. I mean, we've had lots of recordings where we've talked about a lot of these strategies, but it just feels like we have to keep putting the information out there, because when I saw that video right away, I'm like, there was ways that we could have avoided some of that financial tax burden, right? Had they just sat down with, like you said, an independent wealth advisor.
Yeah. And I guess the question becomes, is there a better way to protect your legacy? And the answer is yes. With smart planning and going through the process with somebody, again, there's a lot of commercials out there that talk about, saving your money right now, but what is the longer term outcome will cost you more, right? And again, we're not going to, you come talk to us about what it is, the value that we bring, not only our team, ourselves, but the experience of knowing that not every individual is a cookie cutter, and we're not going to please people. We're going to find out what your individual goals are, what you want your outcome to be, and making sure that we're doing the best that we can to execute your strategy, your goal, to make sure that something like this doesn't happen to yet another person. And again, I watched this video again last night, and you just kind of shake your head. You're like, wow, the more we can inform people, the more through cash flow solutions about being able to really educate people financial literacy, that there isn't always one way, and one way is really kind of a losing outcome for a lot of people. So,
or you might think that the way that everyone else is doing it is the right way, not realizing that there is a better way potentially, right? So I think we're going to end this here, Ryan. All I know is if you're out there and you have a large sum of money in your RSP or registered portfolio, you want to avoid having to pay hundreds of thousands of dollars in taxes and give all that money just like that after working for 45 years in your life, and just to give it away to CRA just like that because of poor planning, and you want to avoid that, reach out to us, right? So they can find us at tvhgroup.ca. That's where they'll see all of the partners there and the different businesses underneath TVH Group, right? From mortgages to accounting to legal to what we do, right? On the wealth advisor side of things, portfolio management, we have private wealth advisor, cash flow solutions. Just come visit. Take 5 minutes, and I'll guarantee you're going to see things that maybe you've never seen before, right? And we just encourage you to reach out to us.
Take control of your financial future and being able to really help with planning out everything, really addressing all the tax, legal, all the things that come with it when it comes to planning your legacy. So,
because if you don't take control of your own financial future, the government's going to take control of all that money, and they're going to take it in and do whatever with it, right? So we want to avoid that from happening. So I think this was a great session. Till next time, have a wonderful evening, Ryan. Take care.
Why is it me? Why am I a guy? I still buy low, we still sell